In the past 24 hours, the probability of the Federal Reserve cutting rates at its next FOMC meeting has fallen by 14 percentage points, from 56% down to 42%. That is not a minor fluctuation. That is a market repricing a fundamental expectation, and over $1.8 million in volume confirms this is not the product of a thin order book being moved by one large participant. Something material has changed, and in this video we are going to explain exactly what and what comes next. Three distinct developments drove this repricing in close succession. First, the latest inflation print came in at 3.4% against a consensus forecast of 3.1%, a meaningful upside surprise that directly undermines the conditions the Fed has cited as prerequisites for beginning to ease. Second, Chair Powell's remarks struck a noticeably hawkish tone in what amounted to a preview of the Jackson Hole address. Markets read that language as signaling patience, not urgency. Third, two voting members of the FOMC explicitly pushed back against near-term easing, reducing the likelihood of the coalition forming around a rate reduction at the next meeting. Each of these headlines alone would have moved the market. Together they delivered a decisive, internally consistent repricing, and that coherence is what makes it credible. A 14-point probability decline carries substantial interpretive weight in prediction markets. The contract has moved from territory where a cut was the base case above 50% into territory where genuine uncertainty dominates. Traders are not forecasting a rate rise, they are withdrawing confidence that a cut materializes at this specific meeting. That is an important distinction. With $3.15 million sitting in liquidity, this is a deep, well-capitalized market. A price move of this scale in a liquid instrument reflects real conviction, not a few large contracts pushing against thin resistance. The shift from 56 to 42 is a fundamental reassessment of near-term Fed policy, not mean reversion. The smart money flow signal on this market is reading as sell. In practice, this means the accounts and wallets identified by our platform as historically accurate forecasters have been reducing their exposure to the yes contract, the rate cut outcome. This is meaningful secondary confirmation. When sophisticated capital exits a position, it tends to front-run information the broader market is still working through. The combination of a falling price and a negative flow signal creates a coherent, aligned picture. The informed consensus is moving decisively away from an imminent cut, and they appear to have moved before the headlines fully landed. This pattern has a recent precedent worth examining. In late 2023, a string of stronger-than-expected economic data forced a rapid repricing of rate cut expectations across prediction markets and interest rate derivatives simultaneously. Markets had priced in aggressive easing for early 2024, inflation persistence and deliberate Fed communication pushed that timeline back by several months, and the repricing ultimately continued further than the initial sell-off suggested. Prediction market probabilities on Fed decisions tend to be most volatile in the 3 weeks preceding a meeting, particularly when incoming data contradicts the prevailing narrative. Historically, a swing of this magnitude at this stage of the cycle has been more likely to precede further downward revision than an immediate recovery. The data does not yet support the other direction. Two catalysts deserve close attention in the weeks ahead. The next consumer price index release will either entrench this repricing or partially reverse it. A softer print could push the probability back above 50% with some speed, while a second consecutive upside surprise would likely drive it below 35%. Any scheduled Fed communications will be parsed closely for even minor shifts in tone. If you want to be notified the moment this probability moves again, subscribe to this channel and follow the link in the pinned comment below to join the Telegram community, where these alerts go out in real time.